What's going on, guys? Bryan Roach here, your agent here in Miami, Florida. I'm here today with Christina Fernandez from Sons & Home Mortgage. And today we're going to discuss about relevant topics that are happening in today's real estate market with financing and the market in general. So Christina, once again, thank you for accepting this invitation to do another video with myself and to inform our viewers what's going on with the real estate market, especially in the financing side, that a lot of people are a little bit nervous of what's going on with the interest rates, the programs, and all that information that's out there that people get confused with. So thank you so much for taking a little bit of your time to speak with us today.
Thank you for having me, Bryan.
Of course. I wanted to start off asking you, I think the most beneficial question for our viewers to know what programs are out there, and I think this is one of the best ones currently available. So it's called the Hometown Heroes Program. What is that program all about, and how does it work?
The Hometown Heroes Program is a very good program that the state of Florida came out with. There is a huge list of occupations on that program, people that qualify for it.
Okay.
A lot of people think that it has to be a firefighter, a police officer, a nurse. They're on there, but there's definitely other ones on there. Dental assistants, pharmacy techs are on there, child care workers are on there. So definitely look at the list because you could qualify for the program. Now, the program gives down payment assistance and closing cost assistance. 5% of the loan amount up to $25,000 for first-time home buyers that have a full-time occupation within that list that we're going to link onto this video.
Yeah, for sure.
It's a great program. It's easy. Typically, these down payment assistance programs, you have to jump through hoops. There's waiting lists for the money. The Hometown Heroes is extremely easy. It gets processed with your first mortgage. It is a second mortgage.
Okay.
No interest, payable at the end of your first mortgage. So when you pay off the house or when you sell or refinance.
Gotcha.
So it is a loan, but there's no interest to it. And it gives you 5%, which we know is enough to maybe do like a 3.5 FHA down payment, and then you have a 1.5 for closing costs. So you come in with really minimal money.
Right.
You can purchase a property with $5,000 to $10,000 depending on what you do. So it's a great program. Again, easy to process. These down payment assistance programs always have income limits.
Right.
The income limit on the Hometown Heroes is $146,250. So it's a high limit.
Yeah, it's plenty, yeah.
Again, I'm really excited about the program. We're doing it a lot. It's great.
So the key here that I want you guys to take away is it's not just for firefighters, policemen, and nurses. There's so many other more occupations that do qualify for this program. So take some time, if you are looking to purchase, to review the document that we are going to link up with this video, so you can see. You never know, maybe your profession is part of this program where you can qualify for. So you said up to 5% of the loan amount.
Of the loan amount.
Of the loan amount.
Not to exceed $25,000.
Got it. And they don't really technically have to pay it back until they finish paying off the first loan.
Correct.
And then, or if they sell before, then they'll pay it off.
Refinance. And there's no accrued interest. So it is a loan, again, a second mortgage, but it's 0% interest.
0%. Cool.
So it's a great program.
Can't get any cheaper than that.
No, it can't. It can't. And again, there's a lot of people on the list. It's an amazing program. It is, again, first-time home buyer. There's something important when we say first-time home buyer. First-time home buyer, you could have purchased a property at some point. In technical mortgage terms, a first-time home buyer is somebody that has not owned a property for the last 3 years. So if you purchased a property 10 years ago, sold it 5 years ago, and you haven't owned real estate in the last 5 years, you can do a Hometown Heroes.
Gotcha. Awesome.
So that's important. The other important thing to mention is that it does have to be on your primary residence.
Yeah,
so you
of
do
have
to live in the
if
property.
you're a first-time buyer, you can't do it on an investment.
On investment,
Right,
you have to live in the property.
You can't be sneaky. You can't. What do they say? Make the cake and eat it too.
Yeah, no. You have to live it. But again, an amazing program. The state funded it probably about a year ago, and now on July 1st, they're funding another $100 million into the program.
Yeah, we were talking about that off camera, that they're going to add more funds to it because of how successful it's been.
Yes.
And listen guys, it's money that the state is providing to you guys as homeowners. Whether you use it or not on your primary is your choice, but if you qualify, you might as well apply for it. It's, I think, a program that will allow you to buy with a lot less money down if that's one of your hurdles that you have to go through. So definitely take advantage of it. Christina, the other day we discussed what a 2-and-1 buy down was. I actually did a short video for the ones that haven't seen it. I highly recommend you go check it out. It's on my Instagram and YouTube as well. But if you haven't seen it, Christina, I wanted you to kind of explain to us what is a 2-and-1 buy down and who can use it and how does it work and what are the benefits of it?
So a 2-1 buy down is a mortgage financing technique.
Okay.
What we do is we use a seller contribution to buy down the rate temporary for the first 2 years. So you buy down the rate 2% for 12 months and 1% for 1 month. And again, it's done with a seller contribution. The way that it works is the difference between the permanent rate, let's call it, and let's just use a rate today of 6.75.
Okay.
So if we use the rate of 6.75 and we use a 4.75 for the first year, let's say that the difference on the principal and interest payment is $500 a month, just to use a number.
Right.
So we would need $6,000 from the seller to cover the first year. And let's just say that the principal and interest payment on the difference between a 6.75, again, permanent rate, and the 1%, 5.75, is, let's say, $250. So we would need $3,000 for that year. So we would need a $9,000 seller contribution. And the way that it works is the bank holds those $9,000 in, it's not an escrow account, but it's a buy down account. That kind of works like an escrow account. So you make your payment and the lender takes out the $500 for the first 12 months to make up the difference. It eases the borrower into the payment. That's the point. The point is to not maybe go from a $3,000 rent to a $4,000 mortgage. You can have a $3,500 mortgage for the first year, and then a $3,750. Yeah, so it kind of eases the people into the payment little by little.
Gotcha. Just to clarify, so if someone gets a chance, and by the way, that's something that as agents and loan originators, we have to work together on this because we have to negotiate with the sellers to make sure they actually give us that credit.
Correct.
To use it towards buying down the rate for the first year and the second year. So just to clarify, the first year on a 2-and-1 buy down, they get a 2% discount for the first year.
Correct.
And a 1% discount for the
second year.
For the second year.
So it's 12 months, and again, the example.
The first 12 months is 2% less, and then then from month 13 to 24 is 1% less.
1% less. Correct.
Okay, gotcha.
Yeah.
Okay, just to clarify. Okay,
Yeah.
perfect. Why would this benefit someone? Why do you think this program would benefit someone?
I mean, it eases. You can take the seller contribution truthfully and use it towards your closing costs and do something like this yourself. I've had clients that have told me, you know what, I think I'd rather just take the $9,000 divided by 24 and maybe pay $300 and something and do it yourself, which is it's another option. It definitely is another option. But again, it eases the borrowers into the payments. You don't take that jump so drastically, if you want to call it that, and you take advantage of the money that the seller is contributing.
Right.
It works out. The other important point to it is if you refinance that loan before the 24 months, so there's still money left over from the buy down, it pays down the principal. So you don't lose the money.
Cool. That's a good point.
The money is not lost.
So the objective of this strategy is to be able to pay a lower monthly payment throughout the beginning of the months of the loan, and you're kind of pretty much betting on the rate coming down a little bit later on, a year or two from now, giving yourself time. If it comes down lower to what the original rate is, you have the opportunity to refinance, and that way you can pay the lower interest rate at the beginning, and then when you refinance, you just continue paying the lower rate moving forward from there.
Correct.
Interesting to know that the money, if you don't use a couple of months of that buy down,
It goes
straight to principal. That's awesome.
Yeah.
I didn't know that. Cool.
Yeah.
Another thing I wanted to talk to you about, because this was huge in the news, it's been all over the news. I'm sure you got bombarded with calls talking about people think that having a lower credit score will get them a bigger discount at the time of buying a property.
No.
I know. It just think about it. It just makes no sense saying it. It makes no sense. But there have been some changes on how much it would cost a borrower from a lower, credit score to a borrower that has a higher credit score. And I wanted you to talk to us a little bit more about that. I think it's called the LLPA. LLPA. So what does it stand for? And tell us more about what changed.
So LLPAs are loan level pricing adjustments.
Okay.
They have been around since 2008. So
Forever.
this is right. This is something that has been around. They have changed. So the charts have changed. Again, they're called adjustments. It's based on loan to value. So depending on your down payment, depends on property type. It depends on what you're going to do with the property.
Right.
So there's loan level pricing adjustments for investment properties, for duplexes, for more down payment, for less down payment, and of course credit score. What was in the news recently was the credit score. So they did do some adjustments to the tables, and they took out some hits. In mortgages we call them hits, or level the pricing adjustments.
Right.
With the 680 score. And that was the big news. If I have a 680, I'm going to get a better rate than if I have a 740. No, you're not. The 680 is not going to get, if you want to call it hit, or it's not going to cost you as much as it did before the So
Gotcha.
basically what they're doing, or what they're trying to do, is help the person with the 680, 700,
Right.
720. And they're taking a little away from the one that had a 740.
Okay.
So they did maybe level out the chart a little more.
Okay.
You were getting a lot better of a positive adjustment if you had a 740, and you were getting a negative adjustment. Of course, negative means higher rate.
Oh, correct.
So you were getting a higher rate if you had a 680, and you were getting a much better rate if you had a 740.
Gotcha.
Now they're trying to level the field a little more. Their conventional financing is trying to attract that 680 score. Typically, 680 would normally go FHA.
To pretty much help out the individuals that maybe have the down payment, have the income, but their
But
scores
don't
may be
have-
a little bit in the average,
Right.
to help them out have a better monthly payment, in other words.
Right.
But I'm gonna put the chart here in this video for you guys to see the breakdown of it. And I remember seeing, I think on the green side, it comes to a point, I think when you're above what, 760 or above that, it's irrelevant for you.
Correct. It's the
Right.
same thing.
Right. So
It's the same thing.
obviously the takeaway of this is always try to have the better score. It's still gonna cost the person with a 680 score more than the 740 individual,
Definitely.
or obviously 760 or above. But having a better score is always going to put you in a better position with a lower rate, which equals lower monthly payment.
And the lower mortgage insurance, which is very important. Mortgage insurance on conventional loans is what's called tier based. So it's based on your credit score.
Right.
So it's super important to have that score as high as possible.
Right.
Yeah.
So guys, don't go out there opening Macy's cards, getting 3 car leases, and then not paying on your student loans. Make sure your credit is well taken care of. Any other questions you guys may have about credit, we can definitely get you guys in contact with credit experts to help you increase your score. Another thing I wanted to ask you, Christina, is kind of tell us a little bit more about the standard requirements to apply for a conventional loan. You know, what are the pros of it, and then the requirements that someone needs to meet to apply.
So to apply for a conventional loan, you need a 620 score. You need employment history for the last 2 years. That employment history can be put together with schooling, as long as you were getting a bachelor's or a master's. So you can come straight out of school, have a job, and the 2-year history can be built with the schooling. So again, 2-year history between schooling and employment. Down payment.
Right, of course.
Conventional, you can purchase with as little as 3% down.
Okay.
Which it's great. Again, a 620 score, and assets, money to buy.
Right.
Money.
So the traditional conventional loan program that people buy and use is the 5% down. But I'm not sure if you guys caught that. You can also buy with 3% down conventional.
Correct.
So if you're looking to buy with as little money down for your primary home, you can use the 3% option or the 5% option.
Correct.
Cool. And can you kind of recap also on what are the requirements to qualify for an FHA loan?
To qualify for an FHA loan, you need a 580 score. There are programs for FHA that let you come in with a lower score than 580.
Wow.
But they get technical. You need a bigger down payment. We need to see why the score is lower. So for something like that, definitely reach out.
Okay.
And we'll evaluate if the score is less than 580. But 580, 3.5% down, Again, a 2-year history of work. We can put it together with schooling, and the money, basically.
Right.
The money to do it. Something important to talk about employment, and it's a myth. Some people think that you need to be at your employer for 2 years. You do not. We can put together, you need a 2-year history of employment. So you could have been, had 2 or 3 different employers within the last 2 years. You could be at this employer for 6 months and have like a 3-month job gap,
Right.
and then the history before that. So don't think that you need to be at the same employer for 2 years. That is not correct.
Right.
You just need a history of working for 2 years.
Gotcha.
Yeah.
And something to clarify as well, I actually shot a video about this as well recently. When they go and qualify for a conventional loan or FHA, do they look at the gross income on the taxes, or do they look at the net income, like the adjusted net income?
So the income that's looked on the taxes it's called adjusted gross income, but
Gross
it's
adjusted.
right. But it is the net. It's so typically when it's netted out means that you were self-employed. So when you look at a Schedule C or a company, you have income, then you have expenses, and then you have what Bryan just said, a net amount. It is the net amount when you're looking at a Schedule C.
Right.
But on the actual tax returns, it's called adjusted gross income
Adjusted gross.
or total income.
Yeah, because the mistakes that you and I have seen multiple times is people make a good amount of money, 100,000, 150, 280,000, and then they go to their accountant, and the accountant trying to show off, I guess, their skills and showing them that they're the best accountant in the world, adds 40, 50, 60, $80,000 worth of,
Expenses.
deductibles and expenses, and then they actually declare a $25,000 income or $20,000 income. Yeah, you made up 200,000, but you're saying on paper that you technically only made 20.
25, and
Right.
it's definitely
And
not.
that can set you back a year or two of wasted time waiting for you to bring your taxes back up to speed.
Correct.
So be aware if you are going to do taxes. Well, I'm not sure when you're going to see this video, but whenever you meet with your accountant, before you meet with your accountant, tell them that your intentions are to buy a property that year, so they know not to get too excited with adding expenses. And if you can actually reach out to your preferred lender or realtor, I'm sure they can give you tips some guidance, because everybody's situation is different. I'm sure they can give you tips and guidance on what to do before you actually file your taxes.
Right. And there are a lot of tips to give self-employed borrowers on deductions that they can take, that they do use, and sometimes they don't take them. They use other ones that can be added back. One very typical one is if they're using a car for a company. As long as that company pays the car for the last 12 months, it doesn't have to be used against the borrower when we're doing their debt to income ratio. And what we do see sometimes is 5 months paid by the company, and then whoops, I paid it with my personal account, and then I started paying it with the company. It's very important that it's 12 months.
Right.
So definitely reach out to a loan advisor, give them your situation, and they'll give you a plan. Typically, borrowers are not ready. If it's a W-2 employee and someone that maybe has been saving money for a while,
That's a little bit easier.
it's a little bit easier to structure yourself to buy a property. But most borrowers aren't ready on that first phone call.
Yeah.
Especially self-employed borrowers.
Yeah.
So definitely reach out and come up with a plan.
Yeah.
Know your numbers, know your plan, so you can become a homeowner, which is extremely important.
Yeah, and that's actually ties right into my next question. Everybody's concerned because the news talks about prices going up, prices going down, rates going up, going down. What do you feel? We're in the Miami market, right? We service South Florida and Florida in general, but what do you feel? I mean, Florida right now is receiving anywhere around 315,000 people to come and live. That was reported last year in 2022. We got 315,000 new residents that changed their mailing address to a Florida address, which is insane. That's like building an entire new metropolis in 1 year. So with that being said, how do you feel the market and the pricing of real estate is going to, develop in the next upcoming 6 months, a year and a half, 2 years?
This is a question I get a lot. I get a lot the question of, do you think prices are going to go down?
Right.
I do not think prices are going to go down. It's a simple supply and demand. There is still a lot of homeowners out there purchasing.
Right.
And there is not enough supply. There isn't. I hear it every day. There's one property, 14 offers.
Yeah.
So one person got that property. So there's still 13 other people still looking in that market. And houses, yeah, they're staying a little bit longer on the market, but if they're priced correctly, they're not staying on the market for more than a couple of days.
Yeah.
The ones that are staying on the market, it's because they're not priced correctly.
Right.
If you look at the ones that are priced correctly, they're selling like hot potatoes.
Yeah, or less.
Yeah, they're selling like hot potatoes. And again, it's supply and demand. It's supply and demand. There's no supply.
And speaking of supply and demand, the Miami Association of Realtors has the most recent report that they provided is that in single-family homes and townhomes in the Miami-Dade County area, the supply left is about 3 months. It's a little bit less, like 2.93 months. And in the condo market, it's about 4 months. Just so you guys have a better idea, a balanced market that appreciates anywhere from 3 to 4% per year needs to have anywhere from 6 to 7 months of inventory left. And if we're at 3 and 4, we're half of that.
Yeah.
Which is right now, Miami, following the traction of buyers and amount of sales that are happening, yeah, it's a lot less transactions than before, but there's still less inventory than buyers. We're estimated to end the year anywhere around 10 to 12% appreciation down here in Miami. So our price is going to come down in Miami, at least no.
No.
Not for the near future.
No.
The other question that I wanted to review with you, Christina, because you talk to a lot of people, a lot of agents and buyers, and you obviously hear their concerns. Is it a good time to buy today?
There's never a bad time to buy real estate. I've been in the market or in the business for 23 years, and when I look back, you think about different moments, different things that have happened in the market, and there really was never a bad time to buy, because even when the prices were high and the rates weren't that high, whoever held on to the property. Right. I bought my house in 2003.
Right.
Paid over appraisal, paid probably 15% out of pocket over appraisal, being in the market.
Right.
And my house is worth 4 times what I paid for it 20 years later.
Yeah. Yeah.
So at one point, yes, did it go down when things crashed?
Right.
But it was my home. It's where I raised my family.
Exactly.
I wasn't going to sell it. I needed it. You need a place to live. So buying your house is your biggest investment, and it's the smartest investment. It's security. It's security for your family. So what I tell clients is, if you feel comfortable with the payment and you have the money, go for it. To definitely go for it. Go ahead and buy the house.
Yeah. Yeah.
Go ahead and buy the house. You're securing your future. You're securing your roof. 19, almost 20 years ago, when I pulled that mortgage on a 30-year loan, it looked like I wasn't, or not that I wasn't going to pay it off, but I saw the moment of paying off that house, and now it's paid.
Yeah. Yeah.
Now
Congrats.
it's paid. Yeah. I just paid it.
Yeah, that's awesome.
Now it's paid. Yeah, I refinanced it down the line, took it into a 15 years and paid it. And now, looking back, it's my retirement. It's what I'm gonna leave my kids.
Exactly.
It's amazing. I mean, like again, looking back, and if you think in those 19, 20 years, everything that happened, at some point I could have said, well, it probably wasn't a good investment, but that's not it. It was an amazing investment. Again, worth 4 times.
Right.
The stability. There's a lot of positive things, not only financially positive things, because financially it's definitely the smartest decision to make.
In the long run, real estate always makes sense.
Definitely the most, but also, again, the stability that you give your family, the stability that you give your kids, that future, and when it's paid, I mean, it's a huge asset.
That's a huge milestone. Congrats, that's amazing.
Thank you.
I completely agree with you, and the fact that, like you said, if you can afford a monthly payment, and you can afford, and you have the down payment there available, why are you going to continue renting? It just makes no sense for you to be paying a landlord's mortgage, an investor's mortgage, because investors, you're paying their mortgage instead of paying your own. If you can afford the monthly payment and have the down payment there in your savings account or your 401k, you might as well buy. And the thing is, I tell my clients, it might look like you're buying at the most expensive time right now. And it's always going to look like you're buying at the most expensive time right now, because real estate is in a constant appreciating motion. It's always going up.
Yeah.
It may go down 2-3% for a couple of months, and then it's going to continue to go back up. Right now, in the United States as a whole, I've seen some other states that the prices might have dropped 1 or 2%. But if you actually consider what happened in 2020, 2021, 2022, we're talking about 30 to 25% appreciation year over year. For it to go down 2-3%, you're already in the green. You're good to go. So same thing happened to me when I purchased this property. When I bought this property, I paid $50,000 over what the most recent sale in the community was. Right, and then 6 months after buying the property, the home was already up $80,000 in equity, and now it's up $200,000 in equity, and it's only been like 2 years.
Correct.
So I'm telling my clients, yeah, it might look expensive right now to buy because prices are definitely higher than before, and the rates might not be the extremely realistic rates that we had before. But if you can afford the monthly payment and you have the money to do it, do it, because 6 months on the road, a year down the road, we can circle back with you and you'll know that you did a great investment for yourself. You're actually going to be mad at yourself that you didn't buy more because you're going to see how much your home appreciated, and obviously if you would have bought more real estate, you would have taken advantage of more appreciation. So
when I started in real estate, my husband loves to buy houses. Bryan knows this. But when we started in real estate, I bought my first house. I think it was like 6 or 7 months later, we bought another one. So the house hacking that everyone does now, I did it again. 2003, probably started in 2001. We bought one house. Then we bought another house 6-7 months later. The bottom line is that the house that I live in now is house number 4.
Gotcha.
But we built a portfolio. Right. It's another subject, but it's a good subject. It's a good subject.
Christy, one other huge myth that we both seen very much is that people think that because they already own a property that they cannot buy again with a low down payment. Is that true? If not, how much down payment can they buy with a second or a third property?
So the down payment on properties relies on what you're going to do with the property. Okay. If you currently own a primary residence and you're purchasing, or even if you own an investment property, if you own a residence now and you're buying a property that you're going to live in, you can purchase it with 5% conventional. Perfect. So again, it's a myth that you need 20% to buy the second property. What determines the down payment is the occupancy.
Which kind of ties into the whole house hacking thing. You could buy a property with 5% down today, use the hometown to your program if you want to, and you live in it for a year and a half or 2, and then you buy another property with 5% down. You can't use hometown here for a second time, can you? Only the first time. But that's fine. You can keep the first one, and rent it out, and move to the second one, and then a year and a half or 2, do it again. And in 6 to 10 years, you have a 5 to 6 dollar property portfolio. That's pretty good. Yeah. So that's awesome, guys. Any other questions you guys may have that's real estate or financing related, please comment below. We'll be more than happy to answer. Christina, thank you so much for your time. I appreciate you spending some time with us to answer some of these questions, to answer all this information that's out there in the news that could be, misinterpreted. So thank you so much, guys. My name is Bryan Roach, your real estate agent here in Miami, Florida, and Christina Fernandez from Sunset Home Mortgage. Anything that's loan or financing related, whether it's refinancing, investment property financing, primary home, you can reach out to her. She is really and truly the best in the industry down here in South Florida.
Thank you, Bryan.
Okay, so we'll be in touch.
Likewise.
Take care, guys.